A lot of investors are wondering, does this tariff conversation and all that really matter when it comes to real estate investors and those that passively invest in real estate? This video is going to unpack that question for you, and you'll find that the answer is probably yes, certainly yes, but maybe not for the reasons you think. If you guys like what we do here at the DeRosa Group, including comment on current events and all those kinds of things, make sure you like this video, subscribe to this channel so you get a notice in your feed for cool stuff like this video that's coming at you all the time. If you guys are a passive investor in real estate or considering passive investing in real estate, I've got a free gift I'm going to give you guys at the very end. 21 questions you guys want to ask syndicators that you guys can use to better vet syndicators you're considering passively investing with. What is a tariff? A tariff is a tax, or you call it a fee, whatever you want, is a fee paid on goods that are imported into a country, charged by the country that you're importing into. So in this case, goods coming into the US are being charged a fee for bringing things into the US. And sometimes it's a misunderstanding on tariffs. It is not the company sending stuff in. So it's not the country of China or a company in China or a company in France or wherever it may be that's being charged that fee. The person being charged the fee is the importer. So if you've got an importing company that's bringing in stuff from China, that US-based importing company is being charged a fee, a tariff. It's not the foreign country, the foreign company either. Either the US-based company, the importer, is being charged the fee. And that's why people say it just gets passed on as a price increase and stuff like that. Sure. Now, maybe it encourages them to go and find better deals on steel or on wine or on appliances or whatever it is they're bringing into the US. It certainly causes the importer to go and try and find other outlets that they can. But at the end of the day, the only option they have is to try and negotiate a better deal with the people sending the stuff in, but also increase the price that they're bringing it in for. So they're bringing in a t-shirt that used to go for $10. If there's a $5 tariff on that t-shirt, it's likely the majority of it's going to go into the price of the t-shirt. And the reason why that is, the incentive that a lot of governments do it is A, for negotiation purposes, to try and strike a better deal with the country of origin that's sending that t-shirt into the US, but also to level the playing field, to make things fair, more fair for the people in the country that you're sending the stuff into, in this case, the United States, because now a US-based manufacturer could likely make that t-shirt for $15 or less and can compete with someone outside the US that has cheaper labor rates, cheaper material costs, cheaper whatever they got, and it levels the playing field a bit. That is the thesis, the theory of tariffs. This video is all about how it affects real estate. So that's what tariffs are. And let's talk about how it affects real estate and real estate investors. So the things that real estate investors typically use when they're developing or rehabbing or just holding rental property, those things just make the list. And you guys can make the list too, but I'll make a few things off the top of my head. Steel. If you're building a new office building or building a new strip center, you're going to lease out and receive passive income on, or even a big multifamily property is going to have a lot of steel in it if you're building it. This is a big one. Appliances, right? Most appliances in the US come in from overseas, either all overseas or they're manufactured in the US with components that are made overseas. And so either way, that appliance piece is going to see a price increase as we continue to move forward through tariff conversations. And even if you own a multifamily or if you're a passive investor in a multifamily apartment building, it begs the question of, well, how often are appliances going to need to be replaced? I can tell you, as a full-time real estate investor for the last 20 years, probably 5 to 7 years, maybe you might eke out 10 years for modern day appliances. The IRS actually allows you to write off an appliance over about 7 years. So that's a signal right there on how long an appliance is set to last. So even if you're an investor in a existing multifamily project, you're going to see appliances need to be replaced on a regular basis through multifamily. And so appliances are a major, major item that you're going to see affect cash flow as a passive investor. The next one, HVAC, heating, ventilation, and air conditioning products. So yet again, that is a complex piece of machinery that is commonly used in the US and is something that either is wholly and completely manufactured overseas or is manufactured in the US with components that are manufactured overseas. And those two pieces of machinery are far and away ones that are used quite a bit in all rental properties. Going further, flooring fixtures, those kinds of things. When you're thinking about what tariffs do affect, think of it this way. This is your big question. What is the thing that is easier to get from another country? For steel, it might be it's just cheaper to get it out of the ground in another country, or something that is more common in another country to bring into the US, right? And that could be a raw material. I'll give you one real example on that one, lumber, right? Lumber is more common in Canada, right? And it's something that there's a big conversation between the US and Canada. Maybe tariffs exist there, maybe they don't. We'll see how that goes. But at the end of the day, a lot of our lumber we use in America comes from Canada. And so there could be a tariff on that lumber because there's just a lot more trees up there, I guess, right? To make a joke. You can think of other things that are prevalent raw materials in other countries. If you really want to go down the rabbit hole, Google it. So that's one thing. Raw materials being used overseas. Second thing is the labor differential. I already talked about that, but I'll touch it again. People in other countries tend to get paid different rates for their time, right? Is what it is. I'm not going to touch that one. It's the third rail, but it is a fact in the world that people in other countries tend to make different labor rates than we do. And so if you've got something that takes a lot of hands and time to make, it will be cheaper to make in that country, such as textiles, such as flooring products, such as complex machinery that require microchips like HVAC appliances, that kind of stuff. So that's why these things tend to cost less in other countries, simply is because of labor rate differential, right? Somebody in the US is going to make this per hour because of the cost of living here, and somebody in another country is going to make this per hour because of the cost of living there, and all the other reasons, including all the politics and all the stuff. Yet again, third rail, not touching it. This video has nothing to do with politics or any of these kinds of things. This is just the world economy that we're commenting on today. Now, that's why tariffs are. Those are some things that affect tariffs for real estate investors. At the end of the day, when tariffs go in, it does have a real material effect on the cost of the good that's having the tariff injected upon it, right? So if you're investing in something as a passive investor that has a new construction element or a major renovation element on it, you want to be cautious. You want to look at the construction timeline for the thing you're getting involved in. I'm in the middle of a project where we're building a 30 unit in Trenton, and it became the question, well, can we change the country of origin for some of these things just so we can avoid tariffs altogether? Are we willing to wait a little bit more time that it might take for that thing? Maybe I can wait another couple of weeks for the thing in exchange for paying a little bit less for it if I buy it from a US-based manufacturer. These are real conversations that we had for that project we're building in Trenton. So bottom line, guys, if you're a passive investor in a project that involves a lot of renovations or new builds, you want to think about questions you should be asking that person you're investing in, that sponsor, about what you're going to do. I'm going to list out those questions in a second here. So guys, when tariffs come into a major renovation or a new construction project, 3 things happen that you need to consider, okay? Number 1, construction timelines are going to change because you might need to find other sources for the raw materials or the complex components you're using in that project. Number 2, your project budget is going to go up, or it could likely go up because of tariffs on that project as well. Here's the other somewhat immaterial, it's tough to measure, but it is a fact when it comes to tariffs as well. If you're investing in a project that's in a market, picture a project that's in Wilmington, North Carolina, okay, that has a lot of seaports, a lot of import-export happens. If you're investing in a market that is going to be materially affected, like Wilmington will be, by tariffs because of a drop in imports, a drop of big ships coming into the harbor perhaps, or a lumber mill is a big source of town or whatever that's bringing the raw material lumber in from overseas or from Canada, whatever it may be. If the industries in the town that you're investing in are very overseas or export product centric, remember that tariffs will cause a shift in the use of that industry, whatever it may be. And you're not going to be able to change the market. This change in the economy is going to come in and it's going to change real economic factors in the market. So look at the market you're investing in and determine, what percent of people have their jobs in things that are affected by things that are coming in from overseas, right? Ask yourself that question. And if it's a lot, then you might want to reconsider that investment, that passive investment you're considering. Maybe that economy is going to change drastically as these tariffs work their way through the US economy, right? Maybe it's a good thing. Maybe there is talk of a plant being developed that makes things that are typically made overseas, like t-shirts, whatever that may be. Maybe it's an opportunity, right? So maybe things could go up as more and more things come back to being made in the US, which is good. And that's a good result of tariffs, right? Or maybe it's something that could go the wrong way, right? So those are the 3 things that tariffs could do to the real estate investing economy. Now let's unpack how this all affects passive investors and how you as a passive investor should be asking the right questions when you're considering something that you're going to be putting your hard-earned dollars into. If you're considering passively investing in a real estate syndication, a group of people putting money into a real estate project, you're not the one swinging the hammer, right? You're not the one that's leasing the units and managing the rehab and managing the day-to-day of the property, but your money is still tied up to the outcomes of those efforts and of the global economy that's affecting that investment that you're in, right? You need to ask your sponsor certain things, right? Here's a few lists of things you should be asking a sponsor before you give them your hard-earned money, or if you've already given your hard-earned money, ask them this question either way, right? What is your contingency budget? You want to see their budget to begin with. So we're going to be buying this property. We're going to be doing lots of rehab on it. What is the budget? I want to see how you've broken down the dollars that we're putting into this big renovation, Mr. and Mrs. Sponsor. Where are you spending my hard-earned money? And then when you look at the budget, you make sure they've got a nice fat contingency line in them. Contingency means, call it rainy day money, set aside for potential changes that may happen. Make sure they've got a really healthy contingency. For big projects, contingencies can be 5%. You want to start seeing those things creep into the 10, 15% range, given changes happening in the cost of raw materials and the cost of complex goods coming in from overseas. So make sure they've got a higher contingency than you would normally expect to see there. Ask them where the materials are coming from. Ask them how they're sourcing materials. Is it just I buy whatever my GC, my general contractor, is sending in, and ask them if they've got a fixed cost contract with that GC, meaning like it's the GC's problem if lumber goes up 10%. The GC has to eat that? Or is it a pass-through where no matter what happens, if materials go up 5%, 10%, it gets passed through? We had a pass-through contract for the 30 unit that we built in Trenton, and HVAC went up 10%, and that got passed through to us. We had to pay it because of the way the contract was written. Okay. So that is something that you want to make sure you understand when you're investing with a sponsor that is doing major renovations, major rehab that could be affected by tariffs, right? Just straight up, of course, ask them, how do you believe tariffs will affect what you're doing? And if so, why, right? Is it going to be a good thing, bad thing, whatever it is? Ask the sponsor those questions. Then take a look at the market. Your sponsor should have a good answer on this, but ask them how tariffs affect the market that they're in. Ask them for the demographic breakdown on the jobs of the market they're investing in. If they say, I don't know, run the other way. They should know who's employing in that town, whether they're building a multifamily property or doing a major gut renovation on a strip center, or just buying a asset that's already existing, is going to cash flow in the market. Well, economies change. Ask them what the fundamentals of the economy are, which is, of course, jobs. Employment centers are typically the foundation economic element for all things. Jobs are where people make the money that they can live in the multifamily that you're investing in, or shop at the strip center you're investing in, or keep their stuff in the self-storage center that you're investing in, or keep their employment going in the office building. Whatever the real estate investment is, likely the economic driver, the money that's going in to keep that project going and to make it healthy, is coming from an employment center, a job in that market. Okay. So study jobs and how inflation and tariffs will affect those jobs long-term, and ask the sponsor that question too. Okay. Now, guys, all these things are things you guys consider. And at the end of the day, the worst thing you could do is sit on your hands, because there is some uncertainty in the market right now because of tariffs, because we're not sure where the economy is going and whatnot. Times of uncertainty are the best time to jump in. Okay. And so I think that you should be passively investing now, or if you're an operator watching this video, you should be out finding deals, because I think that there's a lot of deals to be found. A lot of people are sitting on their hands because they're worried about what the future is. And there's just a little bit of uncertainty, and uncertainty tends to cause people to pause. And when people pause, they slow down on taking action, and that puts less people in the buyer pool and more opportunities to come out. So that's why passive investing is a good idea right now, even in times of uncertainty. Now, if you're considering passive investing, or if you're a sponsor, you're allowed to download this free magnet too. I got a free magnet that you guys should go and grab. It is 21 questions to ask a syndicator. Now, if you're a syndicator, make sure you got the answer to these 21 questions. You can, go grab them and say, hey, my buddy Matt had these 21 questions out here on his website. Here they are, and here's my answer to them. You can show them to a passive investor, no problem. And if you're a passive investor, go and grab these questions, because these are really good questions that I've personally asked syndicators that I've invested with personally. than I've also had asked me by really, really savvy passive investors. So go and grab this list because it's a cheat sheet for passive investors. Why muddle your way through passive investing? Why not get some cheat sheets that are out there to help you become a better, stronger passive investor in the marketplace? And it is something we put out there, capital F, for free. And we've included these questions around construction assumptions, reserves, timelines, everything I talked about today is all in these 21 questions. So you guys want to go and grab that. Each one of these questions could save you thousands and thousands of dollars, or they could open up an opportunity that if these questions get answered right, this could be something that could make you lots and lots of money as a passive investor. You can go to DeRosaGroup.com/top21 or click the link in the comment section below. That is DeRosaGroup.com. There it is, the name, /top21, the number 21. Tariffs are not some far off macro headline. These are real things that are coming into the market now that are affecting the cost of materials, affecting labor costs and delivery timelines, and also investor futures. So these are real things that are happening now that you need to plan for. So whether you're investing in multifamily, hotels, development deals, all of this stuff matters. It's real things that matter. So I appreciate you guys watching this video. Don't forget to download that free guide. Don't forget to like this video and subscribe to this channel so you can hear from your buddy Matt every week for all things going on in the world and how it affects us as real estate investors and affects you as passive investors. Thank you guys for watching. See you next time.